All right, so the different types of audit procedures, we've actually kind of talked a little bit about some of these already as I kind of got off my tangent. So the easiest one to talk about is inspection. You actually look at the documents that you're looking at. Inquiry, about that's going and talking to people. And that's the one I think gets missed, especially with new and newer young people. That was the hardest thing that I could get my new staff members to do that were right out of college. They didn't want to talk to anybody. They just wanted to go get the documents and go sit back in the conference room. They didn't want to talk to anybody. But by talking to people, you get a lot of information. And notice it also says outside the entity. Depends on the type of company. Sometimes you got to talk to people outside the company. Remember I was talking about those guys from ZZ Best? They needed to call the banks. They didn't call the banks. They needed to call the banks. External confirmation, that's the banks. Intangible assets, you got to go look at. Sometimes you got to inspect those things. On the IT side, sometimes we got to go to the off-site backup locations or the off-site disaster recovery locations and look at them. Observation, you go watch it happen. What are you doing? The most common observation is inventory. Right? Recalculation of math. Seems simplistic. Now some of that's going away, more and more computers, but there's still math done by hand. Reperformance of the procedures, and then analytical procedures. This is in your book. Can't remember the exact page. It's in your book. It's obviously a slide. And it just kind of looks through and it goes through all the procedures on one page. So if you want to go through and you're kind of looking at it, it just gives you an example. Inspection of records. All right. Inspect certain records as evidence, looking at land documents. All right. Inquiry. Go talk to the plant manager. How do they do things? Jump down. Inspection of intangible assets. That's the example I gave. Inspection of inventory items. So if you're looking at it and you're kind of like, well, what are they doing? There's some more examples. Reperforming the aging of accounts receivable. That's a reperformance one. Very common. Okay, now we got substantial procedure, further procedures. What else can we do further down the line? So we got test of details. We're going to look at the test of account balances. We're going to look at the test of classes of transactions and the test of disclosures. And one may change the scope of a procedure once you get going. All right. This is where you might broaden the scope once you get in there and realize that maybe you thought you were going to look at 10 transactions and you get in there and you're like, yeah, I think we need to look at a bigger scope. Maybe it's because you find problems right away, or maybe it's because it's not quite what you formed. You got to look at the nature, the timing, and the extent of what's going on. Okay, the nature, timing, and extent of what's going on. And there was, I put that further procedures in there for a reason, but I don't remember why. Oh, it will come to me. I actually left that in there. All right, nature and timing. Okay, so what we're talking about there is things change. So what's the reliability of the evidence? What's the nature of the evidence? Can we hold it to be reliable? If we can't, then we have to change the timing of what we're doing. And we have to change what our audit's going to be. All right? Often things stay the same, but we have to look at the audit evidence that we're looking at. Timing. Do we wait till the end of the year to do the inventory count? When do they take their inventory count? Do they do it a couple times a year? Do they do it only once a year? Well, if they only do it once a year, guess what? We kind of got to go count it once a year. So do we look at that? When do they do their sales cutoff? Well, that's when we want to go look at their sales cutoffs. So they might do testing 2 times a month. We got to look at the timing of different things like that. And then the extent of the procedures, holding other factors into key when we're looking at things. The greater the risk of materiality, the greater the extent of the testing. Right? The more problems we found, we'd go out there and, like, for example, when I would do terminated user IDs, I would always go out and test terminated user IDs. If I went out there and tested 30 and I found 1, I would go look at what that 1 was. And if that 1 person was a sales clerk who didn't have any access, I didn't care. If that 1 was an IT, accounting, finance, HR person, I had a problem. All right? And so then that would probably be an issue by itself, but I would still expand my testing to see did I have it again. Now, if I ran that same procedure and I had 4 people that had terminated user IDs, and they were still all miscellaneous salespeople and people out, I would still run that again. And I'd do another 30. And if I still came up with 4 more, I would write it up. It would not be a significant finding. It would just be a finding. But if I keep finding 4 out of 30, you're not terminating people. You just have been lucky and haven't had anybody that left IT, HR, accounting, and left their user ID out there. And so the risk that you have is IT, accounting, finance, HR, they usually can come in from the outside. So if you don't terminate their ID and they still have access from the outside, you could have a problem. You just hope that they're more diligent on an employee like that than they are with someone else. But you don't know that they are, so it's a finding. You have to write it up. The main way to increase the extent of the audit is to examine more items, which I just said, and sample sizes are usually reduced for less severe things. So if it's not a big item, like backups. You know, if they're doing backups every day, and they're doing a monthly backup every month, and they're doing a yearly backup, then I'm not going to sample their daily backups, their monthly backups, and their yearly backups. That's a little bit of an overkill. I'm going to sample a week's worth of weekly backups. And if they're all performing fine, I'm going to probably look at 1 monthly backup, and I'll look at their 1 yearly backup. And I'm done. But if their daily backups aren't working, I'm probably going to look at more than 1 monthly backup. Because monthly backups tend to be full backups, whereas daily backups tend to be incremental, meaning they only back up things that changed. So I need that monthly backup to work. So you're going to look at detection risk, and you're going to up it based on what you expect to be happening. All right, so the timing of the analytical procedure is going to be based on that risk assessment. When do you think you need to do it? That risk assessment is so important. And the sitting down and before you even go to the audit, there's so much planning. And that was probably the biggest thing I had to learn going out on the Reuben Brown audits versus the Mallinckrodt audits. Because when I went on a Mallinckrodt audit, if I got out there and I needed to stay, I stayed. It was funny money. It was Mallinckrodt paying Mallinckrodt to be at an audit, right? But when I was at Reuben Brown, they were paying us. So I had to know really how much time we were going to be out there. So the planning, you had to sit down and how much time is it going to take to plan this audit? And then when you planned it, you kind of had to be right. So the first time you went out, you really had to sit down on that risk assessment before you went, and you had to figure out what you thought was going on at that location, what you thought was going on at that client. You've got to take the time on that risk assessment. Because if you don't assess that client right, then there's a good chance you're not going to do the audit right. And that's going to make you look bad, which is going to make your company looks bad, which means you're probably not going to have a job very long. Right? All right, and then you got your substantive procedures and you have your final review. And that final review, there's usually 2 stages in the final review. There's the manager reviewing the staff, and then there's partner reviewing the manager. Now, in some CPA firms, you have a senior staff and you have a senior manager. You don't have a senior review and a manager review and a senior manager review. You don't have all those. But if you have a senior staff, you usually have that review and then a manager review. The partner review is kind of fluffy at best. The partner does review things, but they don't do the review like the manager does. It's not that detailed of a review. And then the steps involves, we kind of talked about those with kind of what we just did in that example, but they're going to be looking for account differences, company ratio differences, significant differences that you're not expecting. Then you're going to develop an expectation, prior period information. You're going to go ahead and you're going to look at things like anticipated results. What do you expect to get? Then you're going to look at what's variances. What do you expect? And that's kind of what I was saying with like the backups. If I'm going to do a week's work of the backups, I don't expect a mistake. And if I'm going to do 1 monthly backup and 1 yearly, I expect no mistakes. If I'm going to do 2 weeks worth of backups, I can have a hiccup. Okay, so what's your expectations? What is going to be your anticipated results? Kind of like I told you with terminated employees. Or an accounts receivable. If you have accounts receivable and you're trying to match everything up, what's your anticipated results? You can have 1 error, You can have 2 errors. What about sales cutoffs? I don't think you should have any errors. All right? If you have a cutoff of December 31st, then when you go out to the dock, there better not be that item that you sold. That's called sales cutoffs. So what's the industry information? What's the relationship between the financial information? All that stuff should be well defined when you're planning out the audit. I'm going to get stuck. And then you got your trend analysis and you have your ratio analysis. Now, on the bottom of the ratio analysis, that will plop up probably from your financial accounting. You got your liquidity ratios, your leverage ratio, your profitability ratios, and your activity ratios. Those are things that you will use here because they help you determine quickly what kind of change you're looking at, what kind of problems you're looking at, when you're looking at those ratios. Yep. So, horizontal analysis reviews ratios over time. And that was one that we kind of just looked at here in that problem. We looked at year 1, year 2, year 3, and what we expected. Well, we could look at the ratios between them during a horizontal analysis. Cross-sectional, so what are other firms doing? That does come into play, more on the financial side than ever on the IT side, but what are other firms' growth rate at? All right? And that's going to be really important, like when we were looking at this fraud here. All right? So when I went back and when you guys were working on this, one of the things I thought was interesting was when they said that this company, what did it just say? Its growth rate was astronomical. That's what it said. It tripled its sales from 2012 to 2013. It started in 2010. I don't know, but if I was auditing them, I'd probably go look to see if other pharmaceutical companies that make raw materials, that's what this supposedly did they triple in 3 years? Or was this company just that good that happened to be in St. Louis, Missouri, which I did not know we were a hotbed for making pharmaceuticals, but we are the meth capital of the world, so maybe we're pretty good at that too. But they tripled their sale in product offerings, personnel, and other areas. And they attributed the fraud orchestrated by several entities controlled by Jackson. So that's why you'd look at other companies. So let's compare that. If they would have done that with ZZ Best, they would have figured out that fraud probably before he even went public. But they never looked at him compared to other companies. Vertical analysis, yourself within yourself. Remember that one? You're comparing net income compared to sales. And then other regression and reasonable tests. I love the word reasonableness because that's all in comparison to who's doing it. And there's your analytical procedures with your potential misstatement. So if you're doing a homework problem or potentially on your ethics, there are several times in the text where there are green boxes that have been showing up here and then they're in your textbook that if you get stuck and you're like, well, I don't understand what that procedure means, if you go back, they'll give you examples. They'll give you examples of either what it means or what that potential misstatement could be. So inventory, what's the problem? Misstatement of inventory obsolete, it's not there. So that's what your procedure is trying to figure out. Obviously that one's kind of probably the most common one, but you get into harder ones that sometimes, comparison of research and development expense to budget. Well, you're misclassifying research and development as an expense. That's not an expense. R&D is not necessarily an expense. So you got to look and see how that's being classified. All right, so here's just an example that I liked, and I added a second one on the next slide that I did put out on Blackboard as well, I think. So this could be real or fraud. December 31st credit sales. So this is a real credit sale. We had sales of $700,000 and accounts receivable. Both happened right before year end, which gave us a ratio of sales of 7. Now, if we actually had a cash sale right at the end of the year, that would affect sales, but it would not affect accounts receivable, right? So then our ratio would go to 7.5. So that is classifying it as sales and accounts receivable. If we take that same, did I hit the button? Yeah. If we take that same example, but now it's a cash sale, okay, if we look at the other one was a credit sale, all right? So this time, sales to accounts receivable is still the 7, but now it's an accounts receivable sale, notice the ratio goes down. So the point in this is a lot of times when you look at ratios, you've got to remember that when you have the same thing happen to both ratios, it doesn't say stagnant, right? So that sales went up and cash went up and the ratio went down. Sales went up and accounts receivable stayed the same and the ratio went up. So when you're looking at ratios, just remember that increasing the numerator and the ratio, it increases. Increasing the numerator of the ratio always increases the ratio. Increasing the denominator always decreases it. And then increasing the numerator and denominator by the same amount could have different effects. And so when you're looking at ratios, you've got to be very careful. And a lot of assumptions sometimes are made just by saying the numerator and the denominator both went up. And oh, nothing changed. So you got to be very careful. And those assumptions, a lot of times, even when you're in the field, when people are doing different things and they're doing a ratio analysis in the field, you'll have people that you're auditing be like, well, the ratio didn't change. And you'll be like, you didn't do your math right. And they're like, what are you talking about? But they both went up by 100,000. Do your math again. And it's not even something that should even be an issue, because obviously ratios aren't necessarily on the financial statements, but they did something to make it wrong. All right, so how do we come up with estimates? Oops. All right, review and test to develop the estimates. We got to be very careful when you're looking at management estimates, because estimates are where a lot of discrepancy can be used. And so, and it's very easy to say, for them to tell us, this is what I did. And then you're like, well, how'd you come up with that? And there's no substance behind the estimate. So, review and test the process that they used for developing the estimate. If your answer for the estimate cannot be given, if they can't tell you how they came up with the estimate, that's not an estimate. That's called a guess. Okay? Accounting uses a lot of estimates, but guesses are not estimates. I'm not going to say the company I worked for, and I didn't tell you guys all my jobs, but one of them, it's a big company. And when I left IT and went into accounting, because I wanted to start taking the CPA exam because I did my life backwards, I worked in the budget area. And so every month we had to come up with the budgets of what we thought we could make. And one of the things that drove me crazy, and I think this is pretty common procedure in bigger companies, was I'd come up with the budget, and it was a big company, $7.5 million for this activity, and they'd be like, yeah, that's not big enough. Make it bigger. I'm like, you can't, it's not feasible to be bigger. Yeah, but it's got to be bigger. You know, make it $8.5 million. And I'd have to make it $8.5 million, so that's what I'd put on my budget. It didn't matter that I didn't think there was any realistic way that the salespeople could make $8 million doing this job. That's the number that they wanted in there. Now, it was a budget and it was an estimate, so it wasn't necessarily an audited item that was going to be an issue. I had an issue with it. I absolutely hated it. I don't even like teaching managerial because it's all fluffy stuff. But you know, you have to look at how they came up with it. Independently develop an estimate so that you can compare it to it. If they don't have a way of showing you how they came up with their estimate, then you develop an estimate. You come up with a way and compare it to theirs and be like, okay, you came up with 400,000 and I came up with 200,000. Something's not working. And then sit down and talk to them. And then if they have an issue, that's when you go back. Now, if you're the manager, that's when you write it up. But if they have an issue and you guys can't work it out, that has to be disclosed. Okay? And then you might look at other transactions before you disclose stuff to figure out why are you guys so far apart. Hopefully they can show you how they came up with that estimate. A good business is going to be able to show you how they came up with that estimate. And then fair values, there's 3 different steps. So of coming up with the different values, the quoted price, you're going to look at observable quoted price of similar assets or liabilities. And then if you cannot observe it, you might use like a private company to kind of come up with that item. So that's a little bit harder, but there are 3 different steps that kind of come up with it versus, you know, the estimates. But that's the fair value. So that gets into, that's not quite as common as the estimate, but the fair value of items. And then before we get into the last area is related party transactions. And you just got to remember that you got to be very careful to look at those and who's connected to who and what. A lot of times it's not as cut and dry when you're looking at the financials, because you're not necessarily looking at who the transactions are going to, depending, especially when you're dealing with a big company. Smaller companies sometimes are easier to find these problems out, depending on how you're looking at it, but you got to ask management. You got to ask management who their transactions are with, who they're dealing with. You know, one of the things Ruben Miranda did before every new client is a mass email went out to every manager and every partner asking if anybody had anything to do with XYZ. And I can remember every time we had a new year come up with Schnucks, it came out, does anybody have anything to do with Schnucks? And every time I had to reply back, even though it didn't matter, my mother-in-law and my husband both worked for Schnucks. And my husband's on the Teamster side, which wasn't an issue, but my mother-in-law was on the labor relations side. So if we would have ever, now we did audit on the labor side, but it was an audit and I wasn't on the audit side, so it didn't matter. If I would have been on the audit side, I would not have been able to participate on that audit. And I didn't own any significant amount of stock or anything. I mean, Schnucks is privately held, so it was a difference that way as well. But they had to ask it every time. And then obviously, if anyone does have significant interest, then you can't either be part of it or the company cannot audit it. So you got to dig into that. You got to look at SEC stockholder listings and see if there's any conflict of interest from that standpoint. And then just be alert for related party transactions. And again, the bigger the company, sometimes that's harder to look for. But some things are obvious. You look for loans transactions. Are there bigger loans? Are there different loans for upper level management than you're given for lower level? Because you can't do that. You cannot have different benefits and different loans on things like that for executives versus the staff anymore. So you got to be very careful. All right. Audit documentation. So we're going to talk about a couple things, and then I got a couple examples that I am going to show you of real work papers. All right, so audit documentation. This is your live working papers. This is your evidence. This is what you keep. This is your living Bible. This is what drove me crazy when people couldn't do. All right. What is your primary function of this? This is to support everything you do, whether you're there for a week or you're living your life there for 4 to 6 weeks. This is your support of everything. This is going to support your audit opinion when you're done. That 3-page, 2-page summary, when you're done, this binder this big, or in some cases, the financial people sometimes had like 6 binders. I'd have like 1 or 2 binders, and they'd have like 6 of all their support that supported that 2-page audit report. All right. That's their support for this. The secondary functions, it's assist with any new members coming in. You got to remember, what did I tell you about public accounting? Every 2 to 3 years, right, it's rotating. Partners rotate on a 5-year basis. That's supposedly to keep people fresh, right, and to make sure there's no, I want to say fraud, but improprieties on the partner side within the firm. They change up the partners every 5 years. But every 2 to 3 years, you're getting new staff members. So when this binder rolls over, they look at last year's working papers. Last year's working papers help this year's people. It's not the same, but those binders go with them. Those binders go up to do the work, and they're looking at what did they do last year. So the first year is the hardest, and then those binders serve. It's assist in supervising and reviewing the audit. That's the only thing I had to review. When the audits kept taking place after I wasn't up there every week, I'd go up for 2 days. They were up there for a week. Then they'd go up the next week, and I'd go up for 2 days. All I did was review what they did. If they weren't keeping all those papers in those binders, and now it's electronic, so, but I'm still seeing binders because it's going to be binders in an electronic form, I wouldn't be able to see what they did. And then it also assists with internal review, external peer reviews, which we talked about last week when the CPA firms are reviewed, and then any PCOB inspections or any additional reviews from that standpoint. So what is sufficiency in the audit documentation? Well, it should enable an experienced auditor to be able to go in there and figure out, what did you do? I should be able to look at the audit work papers, and I'm going to show you one in a second, look at it, read it, flip through the binder or the electronic work papers, find the support and be like, oh, okay, and go back. And be able to see exactly what you did with the proof behind it. It should be that easy. And I mean it should be that easy. Identify who did the work and who reviewed the work. So you're looking for initials, again I'm going to show you, and show that we agreed and it agreed to the financial statements. And that's very important. IT is a little bit different, but you guys on the financial side, we had to go back and show how it reconciled back to the financial statements. And audit documentation in the end should include all the findings. Now, not all those findings are going to be shown in the report. There's going to be significant findings, maybe, okay. Then there's going to be mediocre, middle of the road findings, and then there's going to be low findings. All those should be in the audit documentation. Not necessarily all of them make it to the audit report. You're going to only report the significant findings in the report. The other ones are just going to stay in the documentation. Okay, there's different types of work papers. I have to keep hitting every button. Okay, so one more. So we got the administrative work papers, which is what we live on, the working trial balance, and the lead schedules, adjusting journal entries, supporting schedules, the general ledger, reconciliation, computational working papers. So basically, every single living financial document that you just looked at and you created and you reconciled to get the results that you came up with. So for example, in this problem that you guys just did in the book, that would be a working paper. It didn't matter that it ended up being something fancy. If you used it to come up with numbers that you did that showed that it was $359,000 and that was significant to the 286 net income, that was a piece of paper. And a lot of it might have been chicken scratch to come up with that number, but that was support that you had linked to a more formal document that you would link to your working papers that would link to the report. And then you have collaborative documents, which is then even more support. So everything would go in there. Sometimes it would be copies of something you took. Sometimes it would be notes of something you took. And then you have two different types of files. You have your current files and you have your permanent files. Right? Current files are what you're working on now and indexed. And then permanent files are those that were going to stay in the file, the continuing audit file that is going to be kept back at the location, which is usually now it's going to be on a server somewhere for the most part. Not every audit firm is using e-files yet. It took a long time for Reuben Brown to get there. The biggest problem is how do you store it when you're out and how do you secure it? The security was one of the biggest things. When you're at all the numerous locations, and we've had partners get their laptop stolen. So that was a big problem, obviously, when a partner gets his laptop stolen. So do you use the cloud? Do you not use the cloud? The cloud has its own issues. Is it really that secure? You know, where do you store all the client stuff? How do you scan the different documents that you need? Do you travel with scanners? You know, how do you does everyone email you stuff? All those different things came into play. So it's been, you know, when I was at Reuben Brown, we traveled with scanners. You know, and that was before we didn't even do binders at Reuben Brown. We did a lot more E, and we weren't even E yet. You know, I mean, that's what cracked me up. But we were internal, so it made things easier. And I had my own scanner. I thought it was great. And I'm not telling you how long ago because it makes me old, but it was a while ago. And I remember when I first brought it home, I was like, I mean, my scanner was like the size of, it was like two of these, and it just fit in my computer bag, and I took it to every place I went, and they'd give me documents. I'd just be like, okay. Went home with nothing. Went to Reuben Brown, I'm carrying around a binder. I'm like, this kind of sucks. I said, you guys need scanners. And they looked at me like I was crazy, because for them to have scanners, they have to buy them. Mallinckrodt is a company, right, a large, and we're auditing ourselves, so they buy their own scanners. I am, yep. Okay. Yeah, I think you're good. Thanks. So, you know, it's a little bit different. So it just depends on the mentality, and the mentality of public accounting is a little bit different. All right, and then here's just a little flow chart of just kind of how some of the organization of the current files could flow. I'm not sure I'm a big fan of it, but I left it in here. And then the preparation of the working papers. But let me show you, I'm going to pull it up on here as long as it doesn't yell at me. All right, so this is an example, maybe. I wanted the narrative first, but there it is. All right, so this is an example. All right, this is an example of a narrative. So the name of the company just sucks. It's been kind of blanked out, so hopefully you don't see anything you're not supposed to see. It's for, I'm looking to see, the corporate payroll supervisor was the person that was interviewed, and it was the process and payment of payroll. And so a couple of things they're looking at was the payroll journal. Oh, we went too fast, sorry. And so then they went through and they said after they documented who they're talking to, notice like right about here where my cursor is, reviewed by and date reviewed. So yes, you would go out there and you'd interview the person, you'd do the narrative. Now again, you only really do the full one the first time. This next year you go out, you just kind of review what's going on. Did anything change? But you go, you do the narrative, then the reviewer, whether it's a senior staff or the manager, reviews it. Then you come down to any sub-processes. What else is happening in this area? Am I using the wrong mouse key? Yep. What else is happening in this area? Wages, bonuses, paid time off. Here's the different systems used. And then we look at some of the different process, risk, and fraud considerations. All right, well, payroll costs, expenses, and then notice these on the right under control, those are different links to the different controls that they're going to be referenced. So then we come down under payroll. So PR1, okay, so that's what we just referenced up here. They go through and they talk about how is payroll done. That's what we meant by narrative. It's a brief summary of this is what they do and the company arrow structures, okay? This is how they do their payroll. Their hourly employees are paid weekly, bi-weekly on Friday by either check or direct deposit. Salaries are paid bi-weekly or alternating. You know, they go through how everybody is done. And then they kind of talk about how new hires or terminations are done, how payroll is authorized. And so now, just based on those two things, when I go to do the audit, what do I know to look for? I know I'm looking for payroll that should only be happening twice a week. Twice a month, twice a week. And that it should be, and then I come down, and before I came down too far, this one says it should be authorized by hourly employees are basically they're tracked by this hourly employees. Most of them document their hours manually on a time card. Wonderful, because you know what a manual time card means for an auditor? They got to check it, all right? Now, how many they check depends on what they find, all right? Then they're going to look to see who authorizes it. It looks like they use a system called Job Scope, so they'll look at that. And then salary employees are assumed to work a 40-hour week unless notified otherwise, which is kind of what we do at the college. We basically go in, we work unless we tell them we didn't work, all right? Which we pretty much teach. So unless we miss class, or there's a holiday, or we're at a conference, or we're sick, which missed class, we're here. So it's, you know, that's kind of what their assumption is. So that's what a lot of salary employees assume, is you're working unless something happens and you're not there. So that's kind of what they're assuming. It looks like something in California, other paid time off is not tracked by payroll for salary employee. This is due to, so they kind of documented some other things that come into play. Hit the wrong button. Then they talked about how it's processed. Again, they're using this system called job scope. So it's going to talk about different aspects of job scope. So when you're doing this audit, you're going to know what you need to do based on job scope. You wouldn't have known that until you sit down and you do the narrative. The other benefit of this is next year, when someone comes to do the audit, guess what they already know before they get there? They already know that you use job scope, unless you go there and they say, guess what, we switched systems, all right? Which hopefully is something they tell you before you get there. But, all right, so that's all written up. They again tell you a checklist is used by corporate payroll. They kind of go through all this. They reference down here that's PR 1.5. Footnoting is fantastic. It's something you just get very good at if you're an auditor, and it stays with you. We still do it here for anything at the college, and let me tell you what, they know when it comes from the accounting department versus any other department. When you get promoted here, you have to submit a binder. It's a really big pain in the butt, but it's funny because we're used to doing binders. And I've been on the review committee, promotion committee for 4 years until this past one because I was up for promotion, and I'm looking at these binders going, what's wrong with people? They're referencing, their page numbers are a mess. Well, they're not auditors. I mean, they never put it. And so people will come up to us and be like, your guys' binders are great. I'm like, that's because we know how to reference things. And that's from doing these wonderful little audits. And then it keeps going on about, they use ADP also, so job scope and ADP. And notice it's not a small process. And now they got payroll recording, and then they also come down to bonuses. They talk about how the bonuses are done. See, they got the COO, they got the Vice President of Human Resources. They got something called, the bonuses are called Great Game of Business Plans. Sounds great. The CEO, so they reference everybody that's up for the bonuses. And then they kind of keep going. They got the bonus processing. Then they talk about paid time off and how they distribute the checks, which distribution of checks is still important for any company that distributes them. And then we're done. So it's 8 pages. So the payroll was an 8-page typed narrative. Right. It's done. It's a pain in the butt the first time you do it, but then once it's done, it's kind of nice and it's done. So once you have that done, then you can get ready to do the actual audit. So this is for, what are we doing? This cycle is corporate accounting, and it looks like it's the hire to pay job scope, so I think that's the same thing. And they're looking, you can just kind of look at, I'll scroll down and look at some of the activities. So notice over here, this is the control number, PR 1-4. So that's going to link to the working papers. The working papers with this section are going to start with PR 1-4. The key control activity that we're looking at is that only approved users can log into payroll process, job scope, that we were just talking about. All right, a request from a manager to IT forwarded to the payroll supervisor is required for someone to have access. That seems pretty straightforward, right? Then they come over here, frequency is access, it's manual, it's preventive, basically keeping somebody out, it's corporate, it's a medium control risk, and it's a full population, meaning they are sampling everybody that has access to, what were we just looking at, to request, to approve. Well, that makes sense, all right, if you're looking at payroll. And then they tell you how they picked their sample, what was the test procedure, what was the results, when was it performed, and was there a problem. So these 3 columns right here, or these 4, but these 3 columns right here are the important ones. What did you do? All right, how did you pick your sample? What did you do? And what did you find? So remember when I was talking about even like the examples I gave, like with the backup. What was my sample selection? I picked 7 days in a row for my weekly sample. What was my procedure? I went in, I looked at the backup log, I looked to see if it tested, completed without error. All right. What was my results? No findings. All right. I had nothing found. Test performed this day, exception, no, non-effective. Non-effective meaning that was okay. All right. And then over here, a lot of this stays exactly the same. So year after year, that's not going to change. So your working papers flow from year to year. The first year, again, is the hardest year. You got to set it up. But one thing you'll find is some working papers flow to other companies. So a lot of times you can kind of flow over. You can't flow over this stuff. That's going to be blanked out. But some of these things are going to flow over. So these are, now, even before Reuben Brown was electronic, we did the working papers just like this. Right? We always had them in Excel. We always had them typed up. We just printed them and put them in binders. All right, so now when you go across, that's the testing matrix. Now when you go across the bottom, 1.4 was one of the ones we tested. Now 1.5 was the one I think we were just looking at. A checklist is completed by payroll for hourly employees through job scope to ensure that all the steps are done. There's the sample method. There's the testing procedures, and then there's the testing results. So they actually put the detail in here. This is a way of getting rid of making some of the documents of the binder electronic. Now you still got to have copies of stuff, okay? So that's different. You have to scan that. But before, what I would have done is instead of putting week ending yes evidence here, I would have just kept that in the binder and shown how I did it on paper. Now they're trying to put as much in here, and then if you need to see the support, you're going to have to click on a document that's going to open. So you're trying to kind of eliminate people having to open other things. So that's what these tabs across the bottom are. These are the support of the activity. And then notice here, let me go back to this one. Notice the tick mark. So the tick mark's going to take us down. Oh, she didn't. Usually the tick mark is going to click you. Maybe it's because oh, here it is. That they verified with the general manager that the GM and checklist evidenced by a report that was provided to Bobby Brown, I like that name, the HR manager at this time. So, but you can a lot of times set that up. If you click that, it takes you down. But the reason that a lot of times you'll have the tick mark description is it doesn't fit in the box. All right, so then if you would have put this description in that box, the box would have blown up. And it was the same answer every time. And then if you notice the next one I clicked on and went away from, this is support, but notice now we got dollar amounts in here. So testing that we did here, this would have been done in an Excel worksheet before, but it would have been printed and put in the binder. Now it's done on a tab. So it took a while to get a lot of these things. I'm not sure this is the best. I don't know what other places do. This was just an example that I got from Reuben Brown so that I could share it since I didn't get to do electronic work papers. Yeah? Is it? Okay. Okay. And I know there's people from Brown that went to Brownsville-Wallace and people from Brownsville-Wallace that went to Reuben Brown, so I guess I shouldn't be overly surprised. But same flow across the bottom too? Okay. So then you can, there you go. They're pretty universal. So, and who knows where that, maybe somebody somewhere else then kind of came up with the general flow. But I will tell you, as much as even to me, I'd be slightly intimidated if I started back into audit and had to do it because it's not the way I did it. I can tell you it would be easier. I would just have to figure out how I'd do it different to make it easier, but I can tell it would be easier. Even the narratives are done slightly different, but the narratives that I did mainly when I was doing were for SOX, and so they were slightly different because they were SOX narratives. They weren't necessarily audit narratives, and they are just a little bit different. They had a different purpose, but I can tell you, just looking in general, this is better. I just have to get used to it. So, not much for change. It's been a while since I did this, so. So to me, the book doesn't give you guys, and I think it's weird, all the examples they give of all these different things, and look at this chart, and here's what the potential misstatement for this, it doesn't give you any working papers. And so when I was going through it last year, I'm like, are you kidding me? So I had to make a couple phone calls real quick, and I'm like, I need some working papers. I need some audit narratives. So luckily somebody blanked me out a couple real quick and sent them over, so. But that's what you got. So with that,